Welcome to today's Explainer. We're diving straight into one of the most exciting corporate maneuvers we've seen in 2026. I'm talking about Blue Owl's absolute monster of a buyout of Sila Realty Trust. If you've been watching the real estate investment trust sector, or REITs, you know it's been a pretty turbulent few years. But this massive acquisition, it signals a potential seismic shift in the market. We're going to look under the hood of this deal, analyze the hard financial data that made Sila such a prime target, and figure out what this all means for the broader real estate landscape. Here's our roadmap for today. We're going to hit the billion-dollar buyout itself, check out Sila's Q1 scorecard, take a peek inside their healthcare portfolio, review the fine print of the merger, and finally, look at the broader REIT revival. Let's get into it. Starting off with Section 1, the billion-dollar buyout, specifically Blue Owl's all-cash acquisition. So according to a recent SEC filing, affiliates of Blue Owl Real Estate Capital agreed to acquire Sila in a massive all-cash deal valued right around $2.4 billion. I mean, in a market where capital has been tight and debt is pricey, dropping $2.4 billion in pure cash is a huge statement of conviction. They aren't leveraging this to the moon, they're bringing cash to the table to take Sila completely private. And that translates to a definitive offer of $30.38 per share. Naturally, Sila's board took a look at this and unanimously gave it the green light. For stockholders, this is pretty much a dream scenario, a locked-in exit at a premium valuation, completely sidestepping the wild swings of the public markets. But you gotta wonder, right? What exactly did Blue Owls see in Sila's books that made them so eager to write a $2.4 billion check? Well, that brings us to Section 2, Sila's Q1 financial scorecard, highlighting their growth in early 2026. The growth here is just undeniable. If we look at their earnings release, net income jumped from $7.9 million a year earlier, so Q1 2025, to a really robust $12.4 million in the first quarter of 2026. That is a nearly 57% year-over-year increase. Think about that for a second. While a lot of real estate companies are out there just trying to keep their heads above water, Sila was putting up accelerating double-digit profit growth. Plus, the underlying cash flow engines of the business were just firing on all cylinders. They pulled in $52.1 million in rental revenue for the quarter. But the number we really care about is AFFO, adjusted funds from operations. As you know, that's the holy grail metric for REITs because it measures actual cash generated from operations, stripping out stuff like depreciation. Their AFFO hit an impressive $33.5 million. That kind of cash generation easily supported their annualized dividend of $1.60 per share, which comes out to a super healthy payout ratio of just under 67%. Basically, they were making plenty of money to pay out investors and still had cash left over. Moving right along to Section 3, inside the healthcare portfolio, let's look at the actual assets underpinning this deal. You see, Sila is uniquely laser-focused on the healthcare sector. And by holding premium modern properties, they've captured an incredibly reliable tenant base. Healthcare real estate is famously sticky. Tenants pour massive amounts of capital into building out these specialized facilities, and since they provide essential services, they almost never pack up and leave. This creates highly predictable, durable income streams that practically insulate the portfolio from those typical boom and bust cycles we see in standard commercial office space. Just look at the sheer scale of what Sila put together. We're talking 137 high-quality properties spanning 5.3 million rentable square feet across 65 different U.S. markets. But honestly, the most staggering number here is the occupancy. The portfolio was 98.7% leased. In the commercial real estate world, that's essentially fully booked. And these aren't your typical short-term leases either. The weighted average remaining lease term sits at over 10 years. So Blue Owl is effectively buying a full decade of practically guaranteed, contractually obligated rent checks. When you consider tangible, high-quality assets like the Mercy facility, you quickly realize Blue Owl is buying highly reliable, mission-critical infrastructure within the healthcare continuum. These tenants are major regional hospital systems and specialized care providers. By acquiring this real estate, private equity is basically tapping straight into the long-term demographic trends of an aging population, a population that's inevitably going to require a lot more healthcare services. Now, couple those prime physical assets with an absolute fortress of a balance sheet. At the end of Q1, Sila had nearly $465.8 million in total liquidity, which includes their cash and credit facilities. On top of that, they kept a super conservative net debt to enterprise value ratio of just 33.4%. So they weren't over-leveraged at all. They had cash on hand, minimal debt for their size, and a fully leased portfolio. For a private equity firm, this is quite literally the holy grail of acquisition targets, low risk mixed with steady yield. All right, let's get into the mechanics in Section 4, the merger's fine print, covering deal listing and deal protections. The roadmap laid out in their SEC filings is pretty straightforward. Step 1, the deal needs official stockholder approval. Once that's locked in and the customary closing conditions are met, which everyone expects to happen in the second or third quarter of 2026, Sila is going to officially transition. They'll delist their shares from the New York Stock Exchange, wipe the ticker Sila off the board, and become a fully private entity operating under the Blue Owl umbrella. And just to make sure everyone is playing for keeps, and to protect the massive resources spent negotiating all this, the merger agreement includes a really hefty termination fee. If the deal were to completely fall apart under certain specified circumstances, Sila would have to pay Blue Owl roughly $55.7 million. Deal protections like this really highlight the firm commitment from both sides to push this transaction all the way across the finish line. Let's zoom out a bit for Section 5, the broader REIT revival and exactly why private equity is pouncing right now. You might have seen the headlines lately, and financial analysts are spotting a crystal clear trend. Private equity is buying up public REITs hand over fist. We are witnessing a massive influx of institutional capital moving aggressively to take these companies private. So why is this happening right now? Well, the REIT sector is really just starting to recover from a brutal 5-year bear market that was brought on by rising interest rates. Because of that sustained beating, REIT valuations had plummeted to historically attractive discounts. The public markets were essentially pricing these companies for less than the physical buildings they owned were actually worth. Now, private equity firms, who are sitting on absolute mountains of dry powder, are swooping in to scoop up these undervalued assets. Toss in stabilizing interest rates, plus a huge capital influx from AI-driven data center demand that's creating a halo effect across the whole real estate sector, and it's a perfect storm. Private equity sees a golden window to buy low before the broader public market wakes up to the true value of these assets. Bringing it all together, Sila was basically the perfect target in this kind of macro environment. They had stellar, accelerating income growth. They held a massive, almost completely leased healthcare portfolio, generating rock-solid long-term cash flows. Plus, they had exceptional balance sheet health with low leverage and high liquidity. All those factors aligned perfectly, leading directly to this premium $2.4 billion payout for Sila shareholders. Talk about cashing out at exactly the right time. Sila's exit from the public markets is undeniably a massive win for its investors today. But, it leaves us with a really critical, forward-looking question to chew on. With private equity swimming in cash, interest rates finally stabilizing, and public REITs still looking historically undervalued almost across the board, is Sila Realty Trust just the first major domino to fall in a massive wave of upcoming real estate buyouts? Definitely keep your eyes on the market, because the smart money is clearly making its move. Thanks so much for joining me for this explainer, and I'll catch you next time.